Hello, my name is Tarush and I'm here to represent my team, group number 16. Today we are gathered here for a presentation on the book Unusual Billionaires written by Sir Saurabh Mukherjee. This presentation consists of our key learnings and takeaways from this book, and this presentation will go in a linear way, and from here my teammate Reyansh Parekh would take over. Reyansh, you may speak now.
This presentation has some few key points. Let's discuss them one by one. The first, how to identify great companies. There are basically three criteria given by Sir Saurabh Mukherjee in the book Unusual Billionaires. The first basic criteria is market cap. A company should have a market cap of more than 100 CR. Second, longevity. A company should have a history of multiple surviving of multiple economic cycles. Third, in the most important, financial performance. Let's talk about the manufacturing segment. If a company is consistently growing its sales and ROC by 10% and 15% respectively for the last 10 years, then they have entered the elite group of great companies. And in the banking sector, if the company is growing its loan book and ROE by 15% for the last 10 years, then they have entered the elite group of great companies. Now, let's talk about the hallmarks of high quality corporate management. First, Asian Paints. Asian Paints is one of the rare companies where we can see 4 different promoter family having a huge company ownership, yet the company is still run by proper professional managements. Asian Paints has one of the strongest independent board of directors. Berger Paints. Despite changing ownership in Berger Paints, the company is still run by the professionals. They have created a very good working culture inside the company, which results in anyone has a freedom to make mistake and freedom to innovation. Also, anyone from the field level to the sales level can walk into the room of the CEO without the appointment and discuss their views. Marico understood the game that the culture is one of the most important competitive advantage a company can have. Marico built India's first open office where the top management didn't sit in their cabins. Marico also didn't have attendance registered to be daily signed by the employees. Page Industries. Page Industries is entirely run by the professionals, and they maintained a very good relationship with the labor workforce because Page Industries knew labor was the backbone of that company. Axis Bank. Axis Bank is one of a company where they have the highest, best, and the strongest independent board of director, which is proved when Sir Nayak was replaced by Sharma Madam. The board decided to think and act differently again and go against the chairman, which has a gigantic reputation. Also, Axis Bank was the first Indian company to use tools like ESOP to empower the employees. Astral Pipes always took the criticism openly and is never scared of the new experiments. They have a very low attrition rates because of their good working culture. Now let's talk about the competitive edge of Indian market leaders. First, Asian Paints. Asian Paints use the data technology and data analytics to forecast demand so that they can improve the supply chain efficiency. They have a very good deep dealer relationships because they stood with the dealers whenever possible in tough situations like riots, floods, earthquakes, etc. Marico built its strong brand equity purely under tradition, clarity, purity, and aroma. They have one of the most loyalist distribution, which is built on personal knots since Boyle. Early IT adoption by Marico made Marico ahead against their competitors. Page Industry consistently procure high quality yarn with favorable leads, and the inlet processing manufacturing quality led hence they were ahead in the case of quality. Axis Bank. Besides the plain vanilla banking, Axis Bank has the strongest banking franchise. Example, cash management, payments, government businesses. This all led Axis Bank to have the highest current account per branch. SDFC Bank. SDFC Bank mostly has the low-cost deposit franchise because of the two innovations. First, HDFC Bank uses centralized technology to solve the problem of the novel check system settlement for cooperative banks. And second, pulling all the players in the supply chain like buyers, sellers, brokers, and exchanges by giving them automated settlement system. Astral Pipes. Astral Pipes is India's first company to have the exclusive CPVC license obtained by the Lubrizol. And also, they were the first mover in the lead-free pipes. Now, Pushkar will take over.
To understand their dominance, we will examine them through three specific lenses: the trigger or opportunity that started them, the promoter mistakes they survive, and the business strategy that keeps them on top. Moving on to the first slide, triggers or opportunity. Asian Paints utilized the World War II import ban to jumpstart domestic manufacturing. Berger Paints entered the market through British acquisitions, and Marico used the demerger to gain the entrepreneurial autonomy to expand into markets like Bangladesh. Page industry found its opening in the liberalization boom and competitor labor strikes. Axis Bank and HDFC Bank rode the waves of 1990s bank reforms and falling G-Sec yields, while Astral while Astral identified the massive gap of identify and fill the massive gap of CPVC piping in India. Moving on to the next slide, promoter's mistake. The key learning is how these firms professionalize after inevitable early setbacks. Asian Paints had to navigate early promoter labor conflicts. Berger Paints had to stabilize after frequent ownership changes and aggressive expansion that has strained their balance sheets. Marico realized that family style management and over outsourcing were hurting their quality, eventually pivoting to a professionalized model. Astral faced setbacks from poor forex hedging and failed overseas forays. But it's worth noting that HDFC Bank and Page Industries are outliers here, having avoided major mistakes from the start by strictly staying process oriented from the beginning. Moving on to the next slide, business strategies. The final differentiator is the execution model that build their moat. Business strategies. Asian Paints and Berger Paints pioneered the early rural first expansion and a dealer centric model built on strict payment discipline. Marico secured its supply via contract farming and successfully shifted from B2B to a professionalized B2C distribution. Page industry relies on heavy automation, analytics, and strict pricing discipline to maintain quality. Axis Bank focused on retail growth to build a stable liability base, whereas HDFC Bank focused on quality loan books and high margins through a system-led scalability. And Astral maintains a premium pricing and ensures every acquisition is led by certainty of returns. To conclude, these seven companies prove that success is a three-step core process. Identify a trigger, institutionalize the business to survive promoter mistakes, and execute a business strategy that prioritizes distribution and discipline. This is the blueprint for a consistent compounding. Thank you. From now on, my teammate Ibrahim Dahodwala will continue.
I will try to cover three main key learnings of this book: innovations, strategic assets, and architecture. First, innovation. Sir Mukherjee sir argues that for innovation to be a mode, it must be difficult for a competitor to replicate it. In Indian context, this is often less about high-end R&Ds and more about process and supply chain innovation. Sustainability and novelty also helps innovation for a competitive advantage if it is protected by patents, involves processes, secrecies, or is so deeply embedded in the business model that rivals cannot copy it without destroying their own economy. For example, Marico innovated with a round plastic bottles for parachute coconut oil. This wasn't just aesthetic, it was a process innovation that prevented rats from nibbling on the packaging and made it cheaper and more durable for rural distribution. Next slide. Second, architecture. Architecture refers to the network of relationships, formals and informals, that a firm has with its employees, suppliers, and customers. This is often the invisible moat. Internal structures is the ability to align employee interest with the company long-term goals. For example, HDFC, their architecture is built on conservative credit culture and rigorous risk management processes that are hard-coded into the organization's DNA. Next slide. Third, the strategic asset. These are tangible or intangible assets that are provided a monopoly-like advantage or a significant barrier to entry. Data as an asset is a modern era proprietary that is one of the most powerful strategic assets. Asian Paints, they possesses decades for granular data on paint consumption pattern across India. This allowed them to predict demand with incredible accuracy, ensuring their supply chain remains more efficient than any competitor. This includes licenses and networks is also include regulatory permission or physical networks that are too expensive or time consuming for other to build. For example, their HDFC Bank, their low-cost deposit franchisee is a strategic asset because they have a massive trusted brands network. Get capital at much lower cost than most other bank, allowing them to lend more profitability. This also helps to dominate the market and make a proper position for monopoly. Now, my next teammate Tarus will take over from here.
Okay, so branding is a very key important aspect for a company. Companies pay very much to establish or maintain their brands. You might think why to engage in marketing when a company is well established. Well, it's to ensure that the company stays relevant or to maintain their presence in the market. Well, few of the best strategies when it comes to branding I like about amongst these companies are from Asian Paints. How they introduced Kattu, a middle class child, to ensure the Indian middle class market connects with their products, and and they are one of their very successful marketing campaigns, which was Har Ghar Kuch Kehta Hai. Asian Paints understood that the Indians are emotionally and sentimentally very much connected to their houses, and they connected their product, which is paint, to these houses by saying that every home has a feel, and you can use our paints to differentiate your house's vibes or feels. And then comes the Page Industries. Well, they came up with a very great slogan which said jockey but nothing. Sorry, nothing but jockey. And that helped them with their sales from after that. And Axis Bank had a very challenging problem where they had to rebrand their company, and for doing that, they started with celebrity endorsements, and that's how they established their brand to the new world. And one of the best marketing was done by Marico. Marico, as my teammate Ibrahim suggested, that they transitioned from tin bottles to plastic bottles. One of the biggest threats that they faced was that the rats used to, destroy the products. So they engaged in an experiment, and they published the experiment to the retail owners, and that's how they gained their trust. Moving on to my next slide, which is capital allocation. Capital allocation is a very important aspect for a company because funds for any company are limited, and the decision is to where to invest this money in. Either pay the money to the shareholders in the form of dividends, or to reinvest the money in the business to let the business grow. Well, Page Industries was a very great example how they had a rule. They made a very firm and strict rule of not investing into ventures from which they won't be able to generate ROC more than 20%. This rule enabled them to maintain a dividend payout ratio of almost 65%, which was very high at that time. And similarly, Berger Industries was very great with their capital allocation, and they consistently paid almost 35 to 40% of their profits in terms of dividend to their shareholders. Whereas Marico did something wrong. They Because the Marico's industry is FMCG and their working capitals are usually low. Marico had a very great opportunity where the working capitals were actually in negative. So the extra money they had from their daily operations, they used to fund it for the acquisitions they did. But one thing which went wrong for them was these acquisitions led the ROC for a company almost halved during these acquisition phases. And due to this, Marico stopped their acquisitions and started focusing on their key operations. And also to improve their name, they started quarterly dividends, which was where the Marico was amongst the few initial companies that did that. And Asian Paints had also a very great capital allocation system where they did not engage in unrelated, uh, businesses, and they focused their allocation of their capital only to the core business of the company. Moving on to my next slide, uh, these are the challenges that these companies faced. You might be, the it's not like the great companies do not face any kind of challenges during their course. It's how they respond to these challenges which makes them great. Few examples I would like to share are the Berger Industries, Berger Paints. Uh, Due to its transitions of multiple leadership, there are many promoters for these companies. And when Dingra brothers, lastly acquired the business, the financials of the business were very bad. So they initiated a cultural reset, and that's how they, managed with these cultural changes across the company. And then comes the page industry. Well, exactly not the page industry, but Jockey, when they initially entered into the India, they had to quit due to the FERA regulations. But then when they decided to come back after the India opened its economy, they came back with Page Industries. And since then, Page Industries has been the biggest dealership owner for Jockey throughout the world. And lastly, Astral Pipes. Astral Pipes has been very great with their challenges because they faced a very big challenge of entering into market due to existing competitors. But what they did was great. They engaged in plumbers training programs, and due to these, their relationships with these plumbers very much strengthened, and these plumbers started recommending the products to the end consumers. And that's how it also became a marketing strategy indirectly for this company. From now, my teammate Abhishek Nair would take over.
Hi. So now we'll discuss about how these seven companies have strategically diversified their products. So number one is core-led growth. So Berger Paints and Asian Paints have grown into the DIY segment, catering to the demand of the markets. Then comes Axis Bank with the strategic acquisitions of Enam Securities to grow in the specific sector. Then comes strategic divestors. Marico has proven that strategic diversification, strategic divestors of the low margin products and focusing on reallocating the capital into a higher return opportunity. Third comes the complementary diversification. In this, we have Jockey. Jockey, what it did was it diversified into women brand, and Astral also introduced adhesives, which has the same supply chain and distribution synergies. Then comes the geographical diversification. Both the banks in the book, which is HDFC Bank and Axis Bank, both had used this as a key to reduce the concentration risk and develop a market into the rural areas. Next slide, please. Now comes customer-centric product innovation. So in this, there are majorly five major points which I was able to take out of the book. First was comfort and stickiness. So how Jockey was able to understand that comfort is the main core of an innerwear, and it focused on its research and R&D into the comfort and knew that it would stick the customer to that particular brand. Then comes research-driven innovation. In this, we have Marico, and as my teammates have already explained, it has come down to the size of bottles just for the customers. And second comes the Asian Paints, how it understood the market that the particular small size bottles are important and a very key penetrating product for the markets. Then comes one-stop solutions. So both the banks, HDFC and Axis Bank, opened its own technological platform, which brought the customer to its to the platform and provided all the solutions over it. It provided RM, the relationship managers for all the customers, from whom they can avail the services like savings account to taking a big loan. Then comes value added services. So when Axis Bank wanted to provide special services to the HNI clients, it brought Burgundy, which was focused on the HNI clients and the products and services provided to them. Then comes tech enabled platform. So all these companies, these 7 companies, have used technology as a tool to efficiently manage their resources day by day. Next slide, please. Now comes sector characteristics. So all these 7 companies come broadly under these 5 sectors. FMCG being a very high gross margin sector and is a low asset intensity sector with high ROCE. When it comes to paint, it is similar like FMCG, but the gross margins are very less and the competition is very high. When it comes to the banking sector, it has very high regulatory barriers from the RBI, but they are all focusing on a commodity business as they are dealing with money. Then, as we go ahead for the textile sector, it is a highly labor intensive sector with highly fragmented market. The raw material prices are a key. If the company who is dealing in the textile industry, if they're able to take care of the raw material prices and the working capital, they are surely a winner. Then comes the pipes industry. It is again a highly fragmented market and has a significant consolidation of opportunities. Next slide, please. Now here comes the most interesting slide of all, which is the CCP analysis as of date. So for this, we have taken the data of the last 10 years from 2016 to 2025 December. And we have taken the prices of all these stocks and tried to understand how much the CAGR would have been if we would have invested 100 rupees in 2016. For this, we have used Screener as a tool to screen all these stocks under this category. So for this, as Saurabh Mukherjee sir has said, we have taken the market cap as 25,000 crores, sales growth of 15%, ROCE of 10 years to be at 20%, and market capitalization of 10 years back should be more than zero, which means the company should have been listed for more than 10 years from from today's date. So after this criteria, we got 9 companies um, who have been successfully able to come into the screener part. And out of which we have taken 4 companies for the analysis: KEI, Persistent, Blue Star, and TI Industry. So just to give a perspective, if we would have invested 100 rupees in KEI Industry in the year of 2016, it would have turned into 4,053 rupees now, which is approximately a CAGR of 44%. And if we compare it with the index, which is BSE 500, it has given roughly 14% of CAGR till date. So the supporting documents are there in the description, and I hope we were able to we were able to uh, give justice to your time. Thank you so much.